Here we are, October 2022. CPI report came out today. Market's going crazy.
Yes, it is.
Tell me your first impressions.
First impressions was to start the morning off, it was a little rocky. So,
to say the
I
least,
think we were down about 130 basis points on mortgage-backed securities. And then throughout the day, we've kind of rallied. So it'll be interesting how this continues moving forward. What's your take?
Totally agree. I mean, we saw the 10-year get over almost like 4.2% today, which if we think about it, right, it's not that long ago, beginning of the year, we were about 0.5%.
Yeah.
So such a dramatic increase in such a short period of time. And anytime something like that happens, right, we got to remember the market's not used to major volatility like we've seen. And that's why you're seeing interest rates react the way they are, right? So I think what we're going to have to pay attention to is this really that high end, right? Or is this really the level that we can point to and say, okay, this is where it got to its worst, and what can we expect now going forward, right? Into the future. Like, do we have an opportunity to finally breathe a little bit and say, okay, we're going to remember this time as that high point in the market. We're going to hit a little bit of maybe a plateau and then start to get to the other side and say, okay, inflation's at its highest point. Now we're starting to get to a more deflationary environment. Deflationary will mean lower interest rates, right? More confidence in that. But again, I think, how will we know when we're at that number? We never really will until we start to get to the other side, right? That's the thing. You never know when you're at the bottom, or you never know when you're at the top until it starts to turn.
Yep.
Right?
Most definitely.
So, like, talk a little bit about the year over year and how that impacts and why we're looking forward to November when we see the October report come out.
Yeah, so in October of 2021, that's when we began to see, that's when the Federal Reserve began to start seeing that inflation was an issue. So they started to recognize that it was on the rise and began taking action on helping to curb that inflation. So when we see the numbers that come out for October, the year-over-year number, which is the primary driving force of how the markets react to inflation, should be more positive as opposed to what happened this month, in which the year-over-year number increased by 0.4%.
Bingo. So the hard part is, right, we know that October of last year essentially was a little bit too little too late, right? But it was finally something. It was finally action. So because we finally had some action, right, now we're finally going to get some relief. So because the previous year's year-over-year changes were so significant, that year-over-year number of the core inflation reading becomes so high. If we're comparing October of 2022 to October of 2021, that number should be lower. So therefore, we should have a more positive impact on inflation.
Yeah, right? For sure.
The other thing I think we're finally starting to see, right, is more availability for goods, right? Shipping isn't the same nightmare that it was. We're kind of getting over a lot of the manufacturing and material challenges that we had before. So we should start to see overall relief in inflation in all of these different components and areas, right? What's the key number to look at? Jobs, right? We still don't have a really good grasp on jobs. And jobs will dictate how deep into a recession we go, or what the true measure, what the true numbers kind of look like.
Yeah, for sure.
Right? So what are the real job readings out there? Probably way too early to tell, but let's keep our eye on that, right? Going forward, that's going to be a big kind of tracker of how deep into a recession we actually navigate to.
Yeah, for sure. And let's unpack what happened in October 2021. So what's this action that you were talking about earlier?
So the action was the Fed actually increasing the Fed funds rate, right?
Yep.
And so the main misconception out there is that the Fed actually controls mortgage rates.
Mm-hmm.
We know that they don't. The Fed controls the short-term rates. So what the Fed did was finally take action in an effort to curb inflation, was raise that baseline Fed rate.
Mm-hmm.
So by doing so, it almost has a more cumulative effect on long-term rates, right, and mortgage interest rates. But the few times that's happened, well, I shouldn't say few, this year, right, we've seen significant jumps and significant action taken. And when the Fed's actually done that, we've actually seen mortgage rates, for the most part, react positively to that.
Mm-hmm.
Why do you think?
Because when the federal funds rate is increased, the Federal Reserve is taking direct action on trying to curb inflation. Now, the reason we're still seeing the inflation number increase is because typically it takes on average of about 6 months for that federal funds rate to actually affect the economy. So as we continue to move forward, we should start to see less buying, which will then curb the inflation and start to bring prices down. So based on that, what's your prediction of what's going to happen with rates going into the end of Q4 into Q1 in 2023?
Nobody has a crystal ball right now, unfortunately, right? My prediction is that I think, and again, I say this really loosely, but I think we're probably at a point right now where if we're not at that top end of rates, we're probably pretty close to it.
Mm-hmm.
So I think that for Q4, probably into Q1, we're probably not getting much better, which is going to mean a pretty cold winter.
Mm-hmm.
And so we better be prepared and understand that buyer sentiment and buyer affordability is still going to be our biggest challenge.
Yes.
Going into potentially Q2 and Q3 of 2023 is when I actually think that we'll start to see some positive signs. And what's funny is when I say positive signs, I mean positive signs in terms of rates. And I think that we'll see positive signs in terms of rates because we'll see more negative signs in terms of overall economy.
Yes.
So as overall economy deteriorates and we get deeper into a recession, I actually think that that's going to have a more positive impact on mortgage interest rates, because we'll go from a very inflationary environment that we're in today, and we'll inch down to a more deflationary environment, which will have a better impact on long-term rates. Buyers will be happy, etc. Right? Now, the harder part of all of this is, right, how do we navigate from Q3 of 2023, right, or Q4, all the way to Q2 or Q3 of 2023, right? That's where things are going to get difficult, right? We got to come up with these unique strategies on how buyers can take advantage of this market with less buyer activity and capitalize on those opportunities, right? So what are some strategies that buyers can do right now, right, in the current rate environment to really take advantage of the reduced competition and really kind of capitalize on this market, but keep an eye on affordability?
So I would say it depends. It depends on the individual's kind of whole financial situation. And really, I think the best solution is based on how much money that individual has to put down. If you're putting them a minimum amount down, then the strategy that I've been suggesting people is to actually go with the loan program that used to be the looked down upon loan program, which is FHA financing. And the reason for that is because we have the ability to request a 6% seller concession on an FHA loan, and the seller is able to essentially pay down the interest rate. And why that's powerful is because you can take an interest rate, say, for example, at 7%, and you can pay that rate down to a 5.25%. And why this is good is because though we believe that rates are going to go down, there's no guarantee that values are going to continue to increase. So on an FHA loan, if say that person's value of their home doesn't appreciate a certain amount, they can still take advantage of a lower interest rate by doing what's called a streamline refinance, in which they can just refinance their property down to the lower rate.
So those are some gold nuggets. But tell me a couple of things. Number one,
yes,
why FHA now? Why not FHA last year or 2021? Let's
so say. FHA now because it allows you to get the larger seller concession. So on a conventional loan, the max you can get is 3%. On an FHA loan, it's 6%. So that gives you the ability to buy.
And you're talking minimum down payments,
yes,
right?
Yes, minimum down payments.
On a 10% or more conventional, you can get 6%,
yep.
But anything lower, you're stuck at 3%. Go ahead.
So on an FHA loan, you are able to get the 6%, so you can buy the rate down much further, and you can do a streamline in the case that your property doesn't appreciate in value enough, which would potentially hinder you from being able to.
So why weren't people doing FHA before?
They weren't doing FHA before because, we were in the bloodbath. We were like gladiators going into the Coliseum.
So it's the competitive nature of it,
yeah,
right?
Exactly.
Sellers were looking at multiple offers, and they were saying, well, I'm not going to accept FHA if I don't have to,
yep,
right?
Exactly.
So there was a less of a competitive advantage. So buyers would hesitate to use FHA because they didn't want to put themselves at a situation where they would potentially be rated lower than a conventional buyer, right? Now, the other thing is that MIP on an FHA loan, which remember requires an upfront mortgage insurance premium as well. Now, that again gets financed in. So from an affordability play, the advantage here is you buy down, get a lower initial introductory monthly payment, right? Mm-hmm. And the protection that you have is, say you bought a house at $600,000, that house next year, let's say it's maybe worth $590,000, right? We all believe home values aren't crashing. We all believe it's still a wise investment to invest in real estate. Mm-hmm. But can we truly believe that this market might have some volatility in terms of housing, right? That's very possible right now. Yeah. So we have to understand that buyers need to build that volatility into their long-term plan. Mm-hmm. So if interest rates drop to the low 4s or even mid 4s next year, yes. There might be a buyer who buys at a minimum down payment conventional, mm-hmm. and has a rate 6s, close to 7%, but they can't refinance to 4.5%. Because they don't have enough equity in their house that allows them to do that, right? Because you got to have 5% equity minimum. You factor in those costs, right? You're going to have seen appreciation of 6-7%, let's just say, in that first year. Maybe that doesn't occur the first year, right? So FHA gives you that kind of easier opportunity to build in that second transaction in, right? Mm-hmm. Talk a little bit about an FHA Streamline, what's involved, what's included, what's not.
Yeah, so an FHA Streamline is a little bit different than a conventional rate and term refinance, and probably the main difference is that you don't need to get another appraisal. So
it's even easier than that if you think about it, right? The only thing that HUD, who's regulating FHA loans, cares about on your FHA Streamline is, have you paid your FHA mortgage on time?
Yep.
And if you have, right, not only are we going to make it very easy for you to refi, mm-hmm. but that upfront MIP that we just talked about, we're going to give you most of it back, right? So we're going to refund a portion of that. Now you got to do it again, right? But it's not like you have to do it twice. So they're going to take what the current market interest rate is. They're going to build in some costs to it, which would be built back into your new rate on your new FHA loan. But a lot of those costs can be offset by the refund of that upfront MIP, right? So that's where an FHA Streamline is easy. There's no income documentation needed. You don't even have to, I mean, you don't even put employment information on a loan application. It's literally, did you make the payment on time? Here you go. Boom, done. Right? We won't even pull a full credit report. It's called a mortgage only credit report. All we need to see is your mortgage was paid on time. Right? Easy peasy. You're good to go. So I think that's kind of the appeal right now, right? In this new market is there's less competition.
Yep.
To circle it all the way back, right? There's a lot less competition, which means you have an opportunity to frame your offer, yep. Right? In terms of what suits best for your individual financial situation. So maybe that is an FHA loan with seller credit, which allows you to get a more affordable loan up front. And then, the option to streamline that later, right? We haven't even got to 2-1 buy downs. Yes. Right? Which are another big component right now to offer initial affordability at a set price point, right? What's a 2-1 buy down?
So a 2-1 buy down is essentially, say, right now rates are currently quoted at right around 7%. So a 2-1 buy down is the ability to start your interest rate off at not a 6%, at a 5%. So 2% lower than what the current market rate is. And why that's powerful, especially in this market, is because once again, you leverage the seller not having the ability to, or having struggles with getting a buyer who wants to purchase a property. So you can essentially have the seller pay for the surplus interest that would be normally charged over that 2 years, and that individual can start their rate not at a 7%, but at a 5% to help ease the monthly payment initially, with the intention that they'll be able to refinance 12 to 24 months down the road prior to that rate becoming 7% again.
Totally. So again, the powerful component here is you're not actually paying less interest, right? But you're getting a seller maybe to leverage 2% lower in the first year, 1% lower in the second year. They're going to pay that interest for you and front load it so you can ease into that payment. Again, so in your example, right, somebody's at 7%, you still have to qualify at 7%. Yep. But, right, this gives you a 5% monthly payment for that first year, right? And again, the more objection from buyers that we're talking to right now isn't what they can or can't qualify for. It's more of what they're willing to pay on a monthly basis. So this kind of appeases that concern, right? Or mitigates that affordability challenge that a lot of buyers are in, allows them to buy up front, utilizing the seller to supplement some of that upfront interest, and then give them the option to ease into that higher payment, but still take advantage of all of those same refinance opportunities in the future that any other buyer would, right? It doesn't, by doing a 2-1 buy down, doesn't lock you into those first 2 years. It doesn't, require that you have that loan for a certain period of time. You are just as flexible and just as nimble as anybody else. Yep. Right? And if you do an FHA 2-1 buy down, you can still streamline it, right? I mean, again, there's so many different ways that you can take advantage as long as you're open, right, to this current market and creative with how you're structuring it, right? Again, there's not a one-size-fits-all situation, but the right buyer working with the right lender, truly analyzing, they're going to take advantage, and they're going to get themselves in today's price, right? Based on today's level of competition. I think that's the key aspect here. Yeah. Right? Is that you get to compete against nobody else, right? And actually negotiate with the seller. Whereas in previous markets, I would tell buyers all the time, hey, you think you're competing and negotiating with that seller, but truly you're not, right? You're competing against those other buyers because that's your competition. The seller's just going to get the best deal that's offered to them by somebody. Maybe that's you, maybe it's not, right? And I think that's where buyers' mind frame need to change a bit now, where they can really take advantage of less buyer activity, which means more opportunity today.
Yeah. And to caveat on that, also working with the right real estate agent as well, who not only knows the market, but knows the game and is able to work with us and work with the lender to put that plan in motion, and who most importantly is aggressive and not scared to,
It's an upward level of communication
Yes.
that's required right now,
Yep.
right? Communication between buyer and lender, communication between buyer and agent, communication between, selling agent and listing agent and lender, right? Which again is a lost art anymore. So I talk to so many agents that are like, I can't even get a hold of lenders, which is crazy.
Yeah.
But again, you got to really up your level of communication right now, right? Does a buyer or do agents even really understand how 2-1 buy downs work? Most cases not, right? So that's your job to kind of up your level of communication.
Yes.
So that they understand, well, why does my seller need to give $11,000 worth of credit in this transaction? Well, because on a 2-1 buy down, right, which we didn't talk about, buyers can't pay that. So if a buyer can't pay it, who can? A seller can,
Yes.
right? And so again, that's why you can, the seller can counter back and say no credits, but okay, then that's probably no deal.
Yep,
right?
Exactly.
Depending on the loan program they're doing.
Mm-hmm.
So we really need the communication to be upped between listing agents and sellers.
Yes.
And that's literally the lender's job, is to communicate with the listing agent well enough
Yes.
that then the listing agent can communicate with their seller.
Yep.
So they understand why a loan is structured the way it is.
Yeah. And what's interesting about that, when you compare right now to last year, is that last year it was the buyer's agent that had to have that conversation with the buyer, like things
So
such as
true.
you have to waive the appraisal contingency. Sometimes you have to waive the inspection contingency. Sometimes you have to waive all the contingencies.
So true.
Right? And now it's the listing agent's responsibilities to coach and educate their sellers, like, hey, if you want to actually have a fighting chance of selling this house, you may need to bite the bullet and provide some credits, because this, and this is happening in the market right now, and we're having affordability issues. So it's interesting how that's happening now.
I completely agree, right? I think even the conversation between agent and lender had to change, because last year it was, okay, you're going to go with this lender because I trust this guy and he's going to get you approved super fast and he can close super fast and he knows all the other agents, so forth and so on, right? The leverage of the agent to introduce the lender now, that doesn't really matter, right? Now it comes down to, hey, I want to use this lender because they're going to come up with the most creative solutions for you. Mm-hmm. They're going to communicate those and explain them the best so that you understand. And then they're going to help us with structuring your offer that benefits you the most, and help explain that then to the other agent and the seller so that you have a better chance to get your offer accepted under the terms you want, right? Getting an offer accepted is one thing, but let's get the offer accepted under the terms that you want right now and under the conditions that you're comfortable with to pay. Mm-hmm. And sellers, again, we have to understand, if the pool of buyers has diminished and shrunk, if you want to sell your house, I would want to sell my house to as many people in that pool as possible. Yes. So my goal would be, let me open up, right, this to where as many people can get eyes on my house and as many people can qualify to buy my house as possible, right? So the more restrictive you are, the more you close your mind, the more rigid your outlook is. Well, I'm not going to do any of this tricky FHA government stuff. I'm only doing conventional. Well, again, there's still going to be those buyers out there, but it's going to take you a little bit longer, right? And you're going to have to wait for that opportunity to come up rather than be open-minded and allow yourself, the opportunity to sell to everybody else that's out there looking right now.